Hey everyone, exciting announcement here from the Blockworks Podcast Network. We are hiring 2 podcast hosts to build a show with us called Lightspeed. The TLDR of Lightspeed is that it is a show for builders, tinkerers, and lovers of technology. It's a callback to the heyday of Silicon Valley, where great tech was built in garages, not in corporate fortresses, and was truly the Wild West. Lightspeed is an exploration of crypto from the perspective of a builder and an engineer who's designing for scale and is interested in onboarding the next billion users into crypto. If this show sounds exciting to you, you have a background in podcast hosting or content creation, go to the careers page of Blockworks. That's blockworks.co/careers. I've also linked it in the show notes here. You can just click there. It'll take you right to the page. You can also follow me on Twitter. I'm Mike Ippolito _. You can just slide right into my DMs and we'll set up some time to talk. Would love to hear from you. We are super excited about this show. So please apply. All right, everyone. Welcome back to another episode of On the Margin. Today, I am joined by repeat guest Julian Brigden, who is the co-founder of MI2. Julian, welcome back to the show.
Thank you very much indeed. Thanks for having me.
Yeah, absolutely. So we've got a lot of ground to cover, and not as much time as I would ultimately like. I'm sure we could do this for 4 hours, but I'm sure we're going to just have to make it work in the time allotted. So you've put out a couple of really interesting research pieces lately, sort of culminating in the topic du jour of the U.S. dollar. And I want to make sure that we've got enough time to get there. But you kind of started things out by talking about a credit crunch and sort of what your framework is for looking at credit right now. Can you give us kind of the high level of that?
Sure. I mean, so better to be lucky than smart. So we put a piece out the week before SVB talking about a credit crunch. And I think, look, this is how tightening financial conditions are supposed to work, right? We are supposed to tighten credit, right? And I think some of the, I've used this analogy a couple of times, but I think it really is apropos. So if you're a James Bond fan, and you're probably too young to remember, I'm glad I'm on a blurry camera. I don't know what the hell is going on there. But it's my birthday today and I'm feeling a little old. And so get rid of the lines. But the point is you go back in time. You go back in time and there's a movie called GoldenEye. And in GoldenEye, there is a young Alan Cummings and he plays this annoying Russian programmer called Boris, who thinks he's the bee's knees and nothing's ever going to go wrong. And the classic sort of end of the Bond movie, as every Bond movie goes, there's a whole bunch of explosions and the world blows up around Cummings and he looks down and he thinks he's going to be dead, but actually he's alive. All right. And he stands up and he screams, "I am invincible." Okay. And right that second, the liquid nitrogen tanks behind him burst and he's turned into a popsicle. And I think this is this whole concept about this no landing, soft landing stuff that we got at the beginning of the year. And I think it is purely in that same way that people looked around. They looked at 400 odd basis points of rate hikes. They looked at an equity market that was still up there. They looked at consumer that was still strong. They looked at business earnings that were still robust. And they screamed, "I am invincible." And they forget that monetary policy works with a lag and it is coming. And so we got that great, a couple of weeks ago, we had all that hand wringing about the big drop in bank lending. Okay. But there are leading indicators that lead by at least 6 to 9 months that told you that was coming. And it's still coming. And we haven't even seen the effects of SVB, right? The best, only probably beginning next month will we have some indication of what's really happening. We had anecdotal evidence. I think there was a Reuters article, I'm trying to dig it up, where they were interviewing a CEO of a bank, a small regional bank, and he said, I came into this year thinking I should cut lending 50% anyway. I think I need to cut it another 50%. And so this is all coming, and we've seen these things in the past. Credit cycles are what leads the economic cycle pretty much, especially in a world that's so hyper-financialized like our own, right? So I think this idea that we weren't going to get a credit cycle was just ridiculous. That's how monetary policy works. We were going to get one. It's starting. SVB's made it worse. And it's coming on top of other cycles and other problems that we've got economically. So I'm sorry, but I'm in the hard landing camp. I find it very hard to believe anything but that.
Yeah. All right. That's really helpful, Julian, and a very helpful analogy for the GoldenEye villain. Because I've been wondering myself the same thing. I've not been in the no landing or necessarily even soft landing camp, but it does seem at the same time like we're in this sort of weird either eye of the storm or purgatory sort of situation where prices are kind of levitating, but you also have banks that are imploding and a Fed that
Right.
is still indicating that they're going to hike rates. You
Right.
know,
But still providing, greater liquidity to the system, right? And we know,
right.
I mean, it's certainly my view, and I've been in this camp for a long time, that the Fed has created a crack addict to whom they've become beholden, right? And they are the supplier of the crack. And they just boosted the crack. Guess what? I mean, there's no greater proof that fundamentals don't really count when it comes to asset prices than COVID.
Mm.
Right? We were literally going to end the world. We were all going to die, right? And asset prices went up. Why? Because we printed a shitload of money, right?
100%.
Right?
So give listeners kind of like walk them through what are the stages of a credit cycle. And I just want to also rewind the clock. Like, you heard Chair Powell talk about the impact of stress in the banking sector as being equivalent. He said it's impossible to quantify, but could be equivalent to something like a rate hike, right? So you've got the central bank, right? That's intentionally trying to limit credit. And now we've had the commercial banking system say, hold on a second, there's an enormous amount of stress and we are going to ration credit to a much stricter degree. But for audiences who are listening, kind of give them the canonical sense of what a credit cycle typically looks like, and then any changes that might be applicable to this particular cycle.
The way that banking is a con trick at the best of times, right? You borrow money, you lend a lot more than you can provide back. You take that money, you lend it, and it's not going to be available because you lend it for you do this time maturity kind of extension duration trade where you borrow it short and you lend it long. You hope that not everyone comes and asks for their money back at the same time because you definitively can't provide that money, right? And so, but what really dictates the amount of money you lend is obviously the profitability of that lending, right? So the way that banks make their money is they borrow short and they hope to borrow at a very low rate by paying you tuppence, to borrow your money. And then they lend it out for many, many dollars further down the curve because you have a steep curve. So what starts the credit cycle in terms of the tightening is when the central bank starts to raise those short-term rates and the curve starts to flatten, right? Bear flatten. So short-term rates rise. That's a bearish move in the bond market. It's a bear flattener. And then what ultimately really crunches the banks is when the curve inverts, right? Because they're funding themselves at the front end of the curve. Now, the good news is certainly up until recently, they haven't had to pay you anywhere close to Fed funds, right? We all know, we look at our deposit account and we're like, what? 50 basis points, 25 basis points, and Fed funds are 4.5. What is going on, right? Well, they weren't doing that because they didn't have to in some cases, but then all of a sudden we've just seen everyone went, oh, look where money market rates are. Thank you. Take their cash and put it into the market. So that's the process, right? It's not profitable for banks. It's very hard for banks to lend money profitably. If they can borrow at 0.5% and lend it at 3%, great. But when they're paying 3% and lending it at 3.5%, the profit margin isn't there. The risk reward is no longer there. And that's what tightens the credit cycle. And that's where we've got, add in, deposit flight from some of these banks, and you have already a problem. But as I said, this was already happening even before SVB. SVB is just the cherry on the cake, right? It was already happening.
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. they can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later. It was. So where do you see, I mean, give us like a little bit of a timeline here in terms of how long this is going to play out in your mind. And then I want to transition to, the second part of your framework in writing, which was the housing market. So if you
Right.
could just give us kind of a timeline on credit
Look,
cycle.
it depends on exactly where it is, but it ripples its way right across. So clearly it starts to hit the interest rate sensitive sectors of the economy, housing, big ticket items. I think we're going to see auto sales start to deteriorate quite quickly because cost of an auto loan's gone up. Combine that with the fact that the car companies have marched up the cost of a car 50% over the last 10 years, right? So all of those things start to tighten. It'll hit corporate capex. It'll hit C&I loans, so commercial and industrial loans. It will hit commercial real estate. That's a big one. We know as that comes up to maturity, right? The owners of that debt have to renegotiate the cost. They've got a certain return on or cap rate that they're getting from their building. They'll look at it. It'll either make sense or it won't make sense, right? And I think in many cases it's not going to make sense. But the point is, this is a relatively slow process, but it hits everything, right? It is a classic saying, monetary policy is a blunt tool, but it just hits everything, every node, right? It's going to ripple all the way through the economy. And I think it should. I mean, I've sort of stuck my balls on the line a bit and said I think we'll get a negative non-farm payroll number by July. So the June print that we get in July. And I think things are slowing pretty dramatically because we're starting to see credit start to tighten. That's how it works.
Now, could you just, for listeners, we've talked about this on the show before, but just explain again why housing is so tied to the economy. So outside of just sort of the wealth effect and people's wealth being tied up in their homes and the connection between that and interest rates, talk a little bit about the place of housing in the economy. How should people be thinking about that?
Look, when you look at it in absolute terms, it's probably about 20%. You can throw bits in, other bits in, a bit more. But it's very much tied to the cycle, kind of to the animal spirits, to people's sense of wealth effect, to employment. It's very heavily correlated, typically. Unless you're in a period of extreme fiscal spending, right? So we've seen those like Vietnam War, Reagan's defense spending. We saw them post the GFC, where government steps in, or COVID, obviously, where government steps in and they fill any gap left by that kind of underlying housing type. Because it's also interest rate cycle, it goes one and the same with all these other things, right? So it tends to be a pretty decent, solid indicator of wealth, consumer spirits, and underlying activity. I mean, there's a great, there was a Rocket Mortgage ad which they did in the Super Bowl a few years ago, and it was like, wouldn't it be great if it was really easy to get a mortgage, because then you could go and you could buy, new furniture to fill your house. And the guy who makes the hand turned legs on your new settee could also get a mortgage, and blah, blah, blah. And the concluding line was, and isn't really that what America's all about, right? In other words, we build houses, we put people in them, and we sell them shit. And the answer is yes. It's pretty much like that. So it's an important indicator.
Yeah, absolutely. And that housing is, we talked about kind of the stock market levitating a little bit more than I thought it would. And I have to say, I'm not very studied on every single sector of housing in the United States, but broadly, I live here in New York, and rent hasn't changed hardly at all. Price of homes hasn't changed very much. Why have we seen house prices be so stubborn?
Well, I think because it's partly works with a lag. I mean, I think, look, there's no question that we do face a housing shortage, right? But we've been facing that really since 08, 09. I've heard that same argument on many occasions since that period. The problem is we face a bigger affordability issue, right? there's many kids, your age and younger, who would like to be owning a house, right? It's about time. They want to get in. They're preparing to have the kids, right? It's great to live in, in Weehawken or Hoboken, right, which are near you. And when you're young and you get with your girlfriend, you go out and party like rock stars. And then the first kid comes along and you're like, we can do this. We can do this, darling. We can live in the urban little, 1 bedroom, right? Then the second one comes along. Carnage, right? Get me out, right? Get me out. Well, the problem is, it's affording that first starter home has become extraordinarily expensive. And I think, so we've got some of that coming through, and I think there is demand, but people just can't afford it. The cost of the house multiplied by the lack of relative income growth is starting to come through, but not enough, right? And the cost of rates means that affordability is just being atrocious. So, yeah, there's lots of people who want houses. Absolutely true. Can they afford them? No. So it's bloody academic, right? Unless something else comes along and massively reduces the cost, right? A new house is considered, let's say, 5 years from now, a cardboard box with a piece of plastic over the top. Maybe we can afford it, right? But the point is as we build houses right here, right now, houses are unaffordable. And so my concern is when I look at this, we've built quite a lot of homes. They're actually in the pipeline. If you look at houses under completion, they're actually at 55, 60-year highs.
Yeah.
You would think it would be along sort of standard upsloping line, but it isn't. It really is a bit of a sine wave. We kind of build up here, we stop building down here. We've built 43% more homes since the summer of COVID to accommodate that great migration. And those houses are slowly coming and starting to hit the market. And they're hitting a market where affordability is poor. So my supposition is they're going to sell, but then people aren't going to be building a new home behind that. And so what I'm looking for is not a collapse in the housing market. I think prices will adjust a little bit. I mean, by my reckoning, 10% nationally, house prices. But what you're going to see is a significant slowdown in activity. And that, particularly when I look at things like multifamily, where, if you look at the rental space, just the cap rate, the profit that a builder can make for actually building multifamily is not there at the moment, which probably tells you that your rent is probably going up again at some point. And somehow you're going to have to redress that balance. But I think you go into a period where actual new activity in the housing space slows materially. And that will weigh on the economy too, along with that credit cycle.
So, all right. So we've got a credit cycle that is just beginning to start, right? Not great for the economy. We've got a housing market that maybe there's going to be lower activity for a period of time. Maybe houses dip or something up to 10%, but it's certainly not going to be the stimulative force on the economy that it's been since 2020 or 2021. Okay. Now, the next sort of component of your framework that you've laid out is inventories. Talk to us a little bit about inventories.
So look, I mean, since 1985, we've lived in this period that they called the Great Moderation, right? So this period of relatively low volatility in the underlying economic cycle. Obviously, we've had exceptions to GFC and COVID, but outside that, the volatility of the underlying cycle has materially been lower than prior to that. And one reason purported for that is better inventory management, right? We shifted to this just-in-time inventory management. We globalized everything. Everything arrived like on a fine-tuned basis. Like, I need my, it's like the baton race, right? Yeah. The relay. You put your hand back, it's there. You don't look, it's there. You just run, right? I need the components. They're just there. The inventory chain is so efficient. It's just there. Well, COVID blew that to hell. And now deglobalization is layering onto that. So what did we do? We massively overordered, right? We moved to just in case and just in time. We pulled forward demand. Now, some of that may be permanent. Okay. All right, fine. So be it. But the fact of the matter is we are living, particularly when you look at the inventory side, the retail side of the economy, you are living with extraordinary high levels of retail inventory still at this point. And as demand is starting to slow and it's being hidden, right? This is one of those other little secrets of the equity market. The equity market trades off nominal levels of activity, right? Not inflation adjusted, right? Profits are nominal. So classic example, Procter and Gamble, profits last quarter rose, I think 6 to 7%. How did they achieve it? Well, they raised prices 10, which means that the volume of their sales dropped 3. Now, for Procter and Gamble, not a problem, right? Their revenues are up 6 or 7. Woohoo, happy days. But when you start to roll that across the whole economy, in an economy that's already got a lot of inventory, you're talking about your units of sales falling 3. So if you've got high levels of inventory and your units of sales are dropping, your inventory problem is getting worse, not that much better. And the next thing that you have to do as a firm is cut production. So you cut your production 3% and your employment 3%. And that's why it becomes a problem. As I said, just Procter and Gamble do it, no problem. But right across the whole economy, all of a sudden you cut employment 3%, you've got a problem, right? And that's why.
Yeah, and this is the bullwhip effect, right?
Yeah.
Michael Burry was talking about this a little bit earlier. So can you give us a sense of how bad is this? How bad is this problem?
I mean,
today?
look, I think we've got to be a little careful, right? The last real recession any of us really lived through was 08, 09. And that was a credit slump, we would hope, of a century-like epic proportion, right? I don't think it's going to be like that. I just think it's going to be a shitty, nasty recession, right? The average rise in unemployment in a post-war recession is 3.3%. So unemployment to 7%, right? Everyone might go, oh my God, that's what fucking happens, ladies and gentlemen, right? It doesn't, the Fed's fictitious bit of political kabuki theatre, which I call it, right? Their central economic forecast, their SEPs, are a fairy tale. It's never happened, right? We've never had this. What they are proposing is happening. Unemployment's going to go from 3.5 to 4.5. Then it's going to sit there for 3 years, and we're not going to go into recession. Well, you go much more than 0.5% in unemployment. You've always been in a recession. And unemployment doesn't just go to 4.5 and then go sideways. It keeps going until you do something much harder to stop it. Why are they forecasting this? Because they don't want to get into trouble with the politicians and say, yeah, we do intend to break the back of the labour market because that's how you break the back of inflation. And so in that sense, I have to say, for the first time in my life, I agree with Elizabeth Warren. And she was absolutely right when she grilled Powell and said, it doesn't stop there, right? It just keeps going, right? Once we get to 4.5, it won't stop there. And there'll be a lot of people unemployed. And he went, she was right.
Yeah. Hey, you know what? When she's right, she's right. I've got a question before we get into the unemployment. I've got a question for you about inventories. So I before doing this at Blockworks, I used to be a consultant, and one of the things we did was these inventory management projects. And I remember actually a tenet of inventory being the longer your lead time is, the longer the stock of inventory that you need. Just kind of follows logically, right? If it takes 20 weeks, right, or 21 weeks for you to ship something, you have to keep much more on hand in case everyone wants it, as opposed to, let's say, a 1-day lead time.
Yeah.
So I'm just kind of trying to think through this reorganization of the supply chain into something that looks a little bit more multipolar. And I haven't heard anyone talk about this, so I'm a little worried that I might be publicly wrong here or have a false train of thought. But if we end up shifting a bunch of production away from China, Vietnam, to something that feels a little bit more local, a bit of reshoring. Maybe it's not United States domestically, but it's Mexico or something like that, right?
A bit of Europe, blah, 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 blah.
Shouldn't that end up being good? Actually, shouldn't that mean that we should hold less inventories longer term? Because we have...
Arguably, if you can get it that efficient, if you can build it all in your back garden, essentially, and you're just shipping it to the local street, sure, then it is. it's the process, I think, of getting there, and it's also our ability to get hold of certain things, right? I mean, we don't. It's going to take us an awfully long time to rebuild North American industry or European industry to the point that we have all the components that are now plentiful in China.
Mm-hmm. I'm with you. And it's going to take a long period of time, an enormous amount of friction to get from here to there. And, it doesn't really impact your original point, which was currently we have an inventory built up and we're going to need to find a way to work through that.
Right. And the other problem is it's not very profitable spending, right? I mean, this is not, we're not going to really boost productivity by bringing it back onshore. It's a bit like it's great that we're building, green energy now, but from a purely economic perspective, it isn't productive spending because coal, arguably, is just, if not more effective than wind, right? Mm-hmm. It's a choice. And it's all spending that has to be spent. It's all money that has to be raised. It's all debt that has to be financed to not really advance, grow the pie that much more. Maybe better pie, unquestionably. Bigger pie,
Hello, everyone. Thank you all for listening to On the Margin. Just wanted to give you guys a heads up about a conference that we have coming up in the new year called Permissionless. I'm sure most of you have been there last year. It is the cultural event of the year. We had over 5,500 people down in Palm Beach. This year, we are moving to Austin, Texas. You know what they say about Texas? Everything's bigger in Texas. So last year we had a really great lineup of speakers. We had the two co-founders of Robinhood, Vlad Tenev and Baiju Bhatt. We had Chris Dixon. We had some of the folks that have been on the show a whole bunch of times, Jim Bianco, Dan Tapiero. Just a phenomenal lineup of speakers, and you can expect the same this year. If you use Margin 10, you'll get 10% off on a ticket. Again, that's Margin 10 because I love you guys so much. Click the link at the bottom of the show notes. Hope to see you there in person. Yeah. All right. So let's just to recap everything again. Basically, we've got a situation where credit is going to begin to contract. Housing market is at the very least cooling off, probably going down from here. And we've got an inventory buildup. The last piece of this, that you've written about is the U.S. dollar. And it's funny. It's kind of like all roads lead to Rome. All macro roads lead to the U.S. dollar. So take us home. Why is that the last part of what you're focused on?
So look, I mean, we've seen these periods in history before and they're quite common, right? Where, you create these bubble-like conditions, you create a flow of liquidity, you wrap a narrative around the price action. So it's, don't get me wrong, there's a kernel of a good narrative that starts the price action, but you tend to exaggerate you fit the narrative to the price action rather than the other way around. I get calls from journalists, and many of them, of the younger ones, are like, so how do you explain today's up move in the equity market rather than what do you think is going to happen tomorrow, right? So they're constantly chasing the price action. So you create this price action. The price action becomes self-fulfilling. In a true Soros-esque type sense, it becomes reflexive. So that the purchase of the asset associated with the price action reinforces the narrative supporting the price action, et cetera, et cetera. Now, we've had one of those periods in the US, right? The dollar started to rise in 2011, accelerated again in 2014. And as part of that, that started to suck in money into the US, all right? As the money sucked into the US, it goes into equities, makes the US equity market even more attractive, goes into corporate debt, corporates take that money, buy back equity, equity market becomes even more attractive. Wealth effect stimulates growth here in the US, Fed raises rates, dollar becomes even more attractive, right? Economy booms, we suck in even more imports, funded by, you've guessed, even more activity right from foreigners. So all of this thing leads to this big influx of cash into the United States. All right? Now, we've seen this before. We saw it into Japan, heading up into the highs of the Nikkei bubble in the 80s. We saw it in Australia from 2009 to 2013, where you get this really positive virtuous cycle and underlying currency trend. And the underlying currency trend is important, Will, because it sucks in all the world's cash, right? There's nothing more than overseas investors love than 2-for-1. A rising currency that they're investing in this case, in our case, dollars, and an outperforming US asset market. Woohoo! 2-for-1, right? So this becomes the momentum becomes enormous, the inertia becomes extremely strong, and this can carry on for a long, long time. But it is almost by definition an unstable, stable equilibrium because it is dependent on three kind of variables. The first variable is it's dependent on a strong US economy, because if we go into a recession akin to the one we've just described, we won't have such a large current account deficit that's usually associated with a booming economy and an inability of your own domestic industry to satisfy those demands, right? So we won't have such a large current account deficit as the consumer goes back into their shell. And to some degree, the money that we have here now invested funding that from foreigners, it has to come from foreigners to fund that deficit, just goes home. We just don't need it anymore, right? Now that weighs on US asset markets because that's where the money is. And it weighs on the dollar because it's over here unhedged in dollars. Second thing that could go wrong, or we could walk in tomorrow and the US equity market could just drop, right? It could prove to be a bubble and it bursts. Okay, I think there's elements of that, right? We've gone from a statistically impossible, if you look at the US equity market versus its peers, at the highs of 2021, we were 5 standard deviations above our peers. Well, that's statistically nigh on impossible. The good news is we're only 3 standard deviations above our peers at the moment, which is only statistically improbable. Okay, so 0.3% of the time. Okay, so maybe the equity market just drops, it's worth noting that US equities actually, from a foreigner's perspective, are already underperforming their own domestic equities, particularly in Europe. Okay. Option number 3 is the dollar starts to fall. Because if the dollar starts to fall, as I said, foreigners have funded our current account deficit. Thank you very much indeed. But they funded it in euros, which they've taken those euros, sold those euros, bought US assets. That's how they funded it. So they have this massive unhedged currency exposure to a falling dollar. So if they're looking at a combination of underperforming US assets, because the European equity market is rising more than the US equity market, and the euro's actually rising, not falling, the dollar's falling. So I've got this NASDAQ investment in dollars, which when I translate it back into euros is doing worse than if I'd have put my money into the CAC or the DAX, yours. And I think that's kind of where we are, and as the Fed has to face this recession, as they're juggling this difficulty of financial stability versus their inflation fighting credibility, it doesn't make the dollar overly attractive. And please don't get me wrong, I'm not in that Machiavellian, it's the end of the dollar as the reserve currency, it's going away, we're all going to be trading in renminbi or blockchain. I'm like, no, you're not. Okay? What logical person on the planet is going to want to own, the currency of at best, benevolent dictatorship, at worst, an autocratic dictatorship? No one, right? But it doesn't mean the dollar can't fall in value. This thing has fallen 50% in 72, then it fell like 45% after Plaza, then it fell like 38% from 2002 to 2008. So maybe it just falls 35%, right?
Yeah. Now,
we know it's not cheap to go to Europe on holiday.
Yeah, I actually was over in Europe, in London, in November of last year. That was about the period of time where it was almost parity in between the pound and the dollar. I was like, woohoo, let's go. Felt very cheap. But yeah, it's a very interesting idea, Julian. And And that sort of reflexive nature between US economy and especially the bond market and the US dollar
Yeah.
is not something that I'd fully grasped until recently. So just to kind of put that into kind of solid terms, and if I could ask you to kind of dust off your crystal ball here, how do you see that sort of playing out over the course of the next couple of years? Do you expect a relatively weaker dollar, relatively weaker US economy, or let's call it stock market too, if we can maybe differentiate between the strength of the economy, which seems to be definitely in
Right.
decline and we're in a down cycle? How is that going to translate to asset
So
prices?
look, logic would dictate, well, that if you have a weak currency, right, you should have a strong stock market, right? Because you think your exports are cheaper, it's all good. Doesn't really work like that.
Hmm.
Currency strength, as I said, tends to attract funds. So I think certainly as a dollar investor, what we're going to do, I suspect, is when we look back in 4 to 5 years' time, we're going to go, Jesus Christ, I'd have been better having my money in the bloody French equity market or in emerging markets or in precious metals than I would have done in the NASDAQ. Right? I mean, if you look at the price action of the NASDAQ since the dollar started to rise, it's been the only place to have your money. If you looked at the price action of the NASDAQ from 2001, from 2002 really to 2008 when the dollar last declined, it was the worst place to have your money. The worst place to have your money. The best place to have your money was in emerging markets, in commodities, and then in pretty much any other non-US equity market. Okay? Just because the currency makes a big difference. And so I think that's when we look back, that's where I think we're going to go. You can already see it. If you look at the stocks 50 in Europe, right? It's outperforming the S&P in euro terms, clearly. The one that we've got on, which is a bit of a cheeky one, and because it's just moved so damn much, is we recommended for the MI2 client base is long IBEX, so the Spanish market in euros, short the NASDAQ.
That's a cheeky trade.
Yeah, I mean, this thing's gone from like 1 to 12 as a ratio over the last decade. I think it just could go back to 6, right?
Yeah. That was neat. I mean, being 5 standard deviations off anything is, to use statistically impossible. Even 3 is, wildly expensive. So
Yes.
at some point, mean reversion is a very powerful factor, right? It's like
Yeah, and
gravity.
look, it's just the world. It's very mechanical. The world, right? I mean, it is. If you look at it, it is like a ledger, right? If you borrow this, you have to fund it from somewhere else. Where do you fund it from? How do you fund it? What do they buy when they fund it? And that's basically what we're talking about, right? And I think the world just is never linear. It's cycles around a trend. Sometimes those cycles are nice, predictive ones. Sometimes they could be very volatile ones. I'm afraid I think we're moving to a more volatile cycle around the trend. So, to my mind, this is when macro comes into its fore, because it doesn't tell you not to be invested in the equity market, right? Everyone always sort of says, oh, you macro guys, you're all so bloody negative, right? You've got to be invested to make money. Absolutely. I'm not saying you can't. But which equity market, where do you put your money, is really determined by the macro, not by the micro of the corporate results. And I'm telling you now, if the dollar falls for the next 4 to 5 years, which, as I said, this would only be the 4th time. We've only had floating currencies, since 72, right? So it's only been 50 years where we've had 3 big dollar declines. If this is the 4th, NASDAQ ain't where you want to be for the next 5 years.
You know what, Julian? I would completely tend to agree with you. And, I am interested to see NASDAQ, and let's call it not even large cap growth, which I think is becoming more value-ish, right? More focused on profitability and cash flow. But man, for so long, the valuation of these high growth, low cap tech stocks has just been nuts. And we will see. I think there's probably some of those companies that can turn it on and they can turn off the growth spigot a little bit and actually start to realize some profitability.
Sure.
Probably a large amount of them won't. and then we'll
Right.
see when the rubber meets the road, which ones are the right ones to take the bets on. But
I would argue that junior gold miners or silver miners might do just as well, right?
you might be gold looks, I'm not a TA guy. I'll be the first to say that. But if you pull up the chart of gold right now and look at it for the last 10 years, it is forming an absolutely beautiful cup and handle pattern.
Yes,
And
correct.
it looks primed to explode.
Correct.
But
And against the S&P on a log chart, it's starting to break just like it did in 2002 and
mm,
outperform. So I think, you know, that's all I would say is look, don't get me wrong. I mean, I have a buy signal on the S&P. I'm
yeah.
not buying the S&P. I'm buying other things, right? To
Mm.
me, that buy signal in S&P is purely a function of the Fed liquidity provision. And I would rather allocate my tiny weeny portion of that liquidity provision into something else.
Mm. You know what? That's very fair. And the kind of closing question that I want to ask you, just because you brought up the Fed, is this was something we were starting to get into before we recorded, but a couple of months ago, listeners on the margin will know we brought on analyst Warren Pies, and he was describing this sort of contradiction in markets right now, which is if you think of the two sayings that I think are the most widely accepted on Wall Street, it's don't fight the Fed and don't fight the tape. Well,
Mhm.
your liquidity indicator just is signaling to you now is the time to buy, right? But on the other hand, you've got the Fed that they've moved past their banking crisis. They are still going to hike rates. And the Fed is telling you not to buy. So you have these
Right,
two, it's like an unstoppable force meets an immovable object. So
right.
what do you do when you have these two contrasting indicators?
Look, I think you go with the tape, right? I mean, you have no
Mm,
choice but to go with the tape, right? The Fed will have to get ahead of the tape if they want to, right? I'm not, you know, I'm really struggling with being long. As I said, I'm preferring to be long other things. I have my finger on the trigger to be relatively long other things. So by that I mean, if I start to see things falter, there was something I was going to sell against the long that I already own, right? To have a ratio trade on, right? Because I'm a big believer that a lot of these ratios and these divergences, such as that 3 sigma standard deviation that we've got between US stocks and the rest of the world, can correct in one of two ways. We can correct the nice way, where the rest of the world just plays catch up and US stocks trade sideways for the next 5 years, or you can trade the nasty way, where US stocks drop and European and the rest of the world drop, but not as much,
yeah.
right? So that's always an intellectual victory, but a very unsatisfying financial victory, where you go, I'm only down 20% on my European stocks, you're down 50 on your US stocks. Ha ha ha. Right? I'm down 20. I don't want to be down 20. So the point is look, I'm long things and I'm ready to sell some stuff if the tape falters. But for the moment, the tape isn't faltering. The Fed is being forced to compromise on its objectives by events in the financial system. Does that persist? We will see. There are definitely risks to the liquidity situation, as we all know, and I'm sure have been discussed on your show as we move into the second half of the year, right? As if we get a deal on the budget. But I look at stuff, and to me, this is building to a late 60s kind of situation, where the next shoe to drop, where we've had these waves of inflation, the Fed is being compromised on their ability to truly grind the inflation out of the system. Don't get me wrong, they're going to try. The credit crunch will definitively help. But to me, the next shoe to drop, if it does, is the dollar. And if it does, it's going to really complicate the hand of the Fed going forward. It's going to be very, very hard for them to wring inflation out of the system, which is what a weak dollar will encourage, if we have just discovered that the financial system is as vulnerable as it is.
Yeah. Well, I think that's as good of a place to leave it as any. Julian, I always love these chats. If folks want to find out more about you, the good work that you do, what's the best way to follow you or find out more?
So, the easiest thing is to follow me on Twitter at JulianMI2. And then if you're interested in our research or the stuff that we do with Raoul and Macro Insiders on Real Vision, then reach out to support@mi2partners.com.
All right, Julian. Well, thank you very much for your time. As always, appreciate it.
Thanks very much indeed.